And we've made it to Q2. I'm Neville Saliba.
I'm Janice Isler, and together with Neville, we'll be bringing you the second edition of our Financial Reporting and Audit podcast, which covers Q2 2024.
I think we need to start this one off with a massive thank you to all those who got back to us with your feedback and your support from the first podcast.
Definitely. Thank you all for this.
Now we're here. It's July, hopefully in recovery mode from all that busy season between March and June. I can definitely say that about myself and probably also about the audience. So yes, I hope we're all back, we're recovering and we're enjoying summer.
Yes, that's it. This podcast will be covering the newsletter that was written to cover Q2 2024. It was already published on our website, and during these 30 minutes we'll basically just be covering the main points that come out of the newsletter. We will not have time to go into the full detail that is noted in every article, but just to give you a bit of an idea of what is included and a bit of insight into what to expect.
Indeed. Just a quick disclaimer, I remind you that anything we say and anything that's written in the newsletter, whilst we do all our efforts for it to be factual, obviously it shall not be considered as accounting, financial reporting or audit advice. But if you have any questions, if you require any support with anything that we are discussing, feel free to reach out to us and we'll do our best to support.
Should we start off, Neville, something from the audit side, perhaps?
Indeed, let's start off with something from the audit side this time, Jan.
Just a reminder, our newsletter is split into 3 sections, so you will be seeing some news items from the audit side, some from the financial reporting section of the letter, and some also from the ESG section. We don't have time in this newsletter to run through every single news item, but we do try touch upon every item for you to be aware of what is going on. So I will be starting off, Neville, with the new strategy and work plan that was published by the IAASB. And this is basically, it was done to strengthen audit quality. As you know, the quality in our audits is of utmost importance. And they did want to bring uniformity to the current audit and accounting standards, audit and assurance standards that are currently in place globally. The strategy covers the upcoming 3 calendar years, and it basically includes a number of sections that the reader can gain good insight into what the IASB is doing, why it's doing, when it plans to do it, and the plan over there. So you will see a number of sections, within this strategy and work plan, and it basically highlights the fact that they wish to complete a number of priority projects that are currently ongoing at the moment, with a particular emphasis on fraud, going concern, and sustainability assurance. They also want to start new initiatives and projects, and the plan does outline what these projects would be. They wish to collaborate with stakeholders and other regulatory authorities and many more to that.
Okay. So you mentioned, for example, going concern and fraud. Are those the only projects which are currently underway, or?
They do have other projects that are underway. Yes, as you mentioned, there's the going concern. So that's the ISA 570 standard on audit and assurance. There is the fraud standard that they are planning to finalize shortly, which is the ISA 240. There's also the implications for the IAASB standards of the ISBUS project. So we're looking at the project on listed entities and public interest entities. They plan to finalize the revision of ISA 500 on audit evidence, and also ISSA on sustainability assurance.
Quite a bit, quite a few abbreviations there. Yeah.
Definitely. They also have some new initiatives in place, which again, if you were to look at the strategy and work plan, you'll see the detail over there. But it also includes the review of the interim financial information, a post-implementation review of ISA 540, which is basically a standard that was revised. And they just want to carry out this post-implementation review of it, and also a post-implementation review of ISA 315, which was also revised in 2019. So yes, quite a bit happening over there.
So, but at the same time, it's providing us all with a bit of an insight, a bit of a way forward of what we should be expecting over the coming, 3 years we said?
That's it, Neville, that's it. So the upcoming 3 calendar years. There is also, Neville, a new video series that was released by the IAASB. As you know, whenever they revise a standard or introduce a new standard or whatever it might be, there was the standard that the video series that they had done for the ISA for LCs as well. They tend to release a video series to help users better understand what the revisions are or what this new standard is addressing.
In fact, we had something similar to this in the previous podcast.
Exactly, that's it. And in this case, they're talking about a 4-part series on fraud, okay, the revisions to fraud. And what do you expect? What do you see in this 4-part series? One of the sections relates, for example, to an overview of the key changes that you'll find in ISA 240, which is the standard on fraud. Another video focuses on the auditor's responsibilities, okay, which have now been made clearer within the standard. You have a video showing how auditors can better enhance their response to fraud or suspected fraud. And lastly, there's also a video on the changes that aim to enhance transparency within the auditor's report. So definitely a video series worth watching. I always find sometimes we're on the go. We want to keep up to date with certain changes, but we might not have the time. So get into your car, go for an errand, and put on this video series to listen to along the way and update yourself there
Or
and
this
then.
podcast.
Or this podcast. That's it.
Thanks for that, Jan. So, if we're done with that section, Jan, I'd like to move it on to the next one. The main section, I believe the main segment from my end for this podcast, which delves into IFRS 19, subsidiaries without public accountability disclosures.
I did read about this recently, Neville. What are the changes being put forward over here?
May 2024, the IASB published this new standard, IFRS 19, which looks into improvements in IFRS disclosures for multinational organizations.
So we're looking at a new standard here.
So we're looking at a new standard. Last podcast we spoke about IFRS 18, which looked into the presentation side of things. Now IFRS 19 is going to look at the disclosure side of things. So it's going to be focusing on situations where you have a multinational group which has excessive disclosures for its subsidiaries at this point in time. So we have subsidiaries which are being consolidated at a higher level within the group, within the parent, which are duplicating possibly their disclosures both in their standalone financial statements as well as in the parent financial statements. So the situation currently is, let's take for example, we have a parent in Germany and it has a subsidiary in Malta. And the German parent is preparing consolidated financial statements under IFRS, and the Maltese subsidiary has an option either to use GAAP SME or alternatively
IFRS.
to use full IFRSs. If it's using GAAP SME, it has the risk of either keeping two separate sets of accounts or alternatively to convert from GAAP SME to IFRS at the end of each reporting period.
So what do they do?
That is not an ideal situation
No.
as things are, because if you take on full IFRS to be fully converged with the parent, then you'd have a situation of excessive disclosures
That's
at
it.
the level of the subsidiary. And that was the case before IFRS 19 came along. So IFRS 19 specifies the disclosure requirements an entity is permitted to apply instead of the disclosure requirements within the main body of standards.
If I just remind the viewers over here, IFRS 19 relates to subsidiaries without public accountability disclosures. So
Indeed.
it's talking about it's assisting with disclosures in this case.
Indeed. So its main aim is to improve the IFRS disclosure situation for these multinational organizations, because you need to look at the cost of reporting as a group.
So how does this work out, Neville?
Good question. So an entity electing to implement IFRS 19 will basically take on the full body of standards, let's say IFRS 16, from the perspective of recognition, measurement, and the recognition of a lease.
Okay.
But then it will ignore the disclosure requirements in the main body of standards and turn to IFRS 19 for the remainder of the disclosure requirements, or be it the full disclosure requirements related to that standard.
So in this case, when it
So-
comes to disclosures, it's looking at IFRS 19
That
and not at the
particular company,
individual IFRSs. Okay.
Let's imagine that particular company just applying the measurement rules in a particular standard, then turning to IFRS 19 to apply the disclosures within that.
Okay.
So basically, if you'd imagine this IFRS, I downloaded it myself and had a quick look. It's basically a compilation of disclosures from different standards, from different IFRSs, but limited to a particular extent to make it simpler for these subsidiaries to put information out there and not to take on excessive disclosure.
Yes. And what companies would we be looking at here, Neville? Which companies would be affected by
So
this?
the companies which could adopt IFRS 19 are those companies which do not have public accountability, so they are not listed, and they do not have fiduciary capacities such as banks or insurance companies, and companies which have a parent which reports consolidated financial statements under IFRS. Now, mind
Okay.
you, there's a new standard has just been launched. So if you're preparing IFRSs as adopted by the EU, it has not been adopted as yet, but for financial statements which are prepared in line with IFRSs as published by the IASB, they can adopt the standard from the financial reporting periods beginning on or after the 1st January 2027.
Okay. All right.
So yes, it's a new standard. Hopefully it's going to simplify the disclosure side of things with such multinationals with respect to their subsidiaries.
Okay, definitely very helpful there. Obviously, for those who might have further questions on this, please
Definitely.
do get in touch.
Definitely. Now we're going to move on to something a bit more complex, which is with business combinations under common control. So we're going to look into acquisitions within a group and acquisitions which entails that the combining businesses are ultimately controlled by the same party before and after the business combination. Now, IFRS 3 business combinations does provide us with a definition of what business combinations under common control are, but at the same time, it excludes these business combinations out of its scope.
Okay, so
Therefore, we are left without not much of a guideline.
so what do we do in this case if we don't really have sort of guidelines or guidance to abide by?
And this is where I'm going to try to simplify as much as possible, but if the audience is not as used to working on consolidations on a day-to-day basis, it might be a bit confusing.
Okay.
So we have two main ways of looking into business combinations under common control. The first way is called the predecessor method of accounting, and the second method is called the acquisition method. Starting off with the second one, the acquisition method is the main method which IFRS 3 stipulates for consolidations. So you'd basically fair value your net assets at the date of acquisition and you'd account for goodwill. That's what we're normally used to in the case of a consolidation, but in the case of business combinations under common control, you also have the predecessor method option, and this comes from common practice because, as we were saying, we have no guidelines here. And the predecessor method would entail that assets and liabilities are not fair valued at the date of acquisition, but instead they are just brought into consolidations at their carrying amount before the consolidation.
Okay.
Now, this choice is a bit of a matter of judgment, and it has a policy choice which needs to be disclosed in the financial statements, whatever option you take.
Okay.
And we find schools of thought which support both methods, either
Okay.
one or the other.
So that sounds like it could be a bit perhaps confusing to some preparers. So then, how would they address this? How would you suggest?
Indeed, and the ISB did identify this possible source of confusion, and the way they were going to go about it is by issuing a discussion paper back in 2020 to identify perhaps a way forward. Fast forward 3 years, and in November 2023, this project was halted and they did not proceed any further with the findings from that. And the reason out of that is within a project summary which was published this quarter. And this project summary basically stated that the ISB identified that this project would probably not be as fruitful, the outcome out of it would probably not be as fruitful as they originally intended back in 2020.
Okay.
The reason is that different jurisdictions use normally different methods of accounting for these types of business combinations, leading to varied approaches among businesses and, well, leading to difficulty in arriving to a consensus on which method to use to adopt, therefore bringing this project to an unfortunate end.
Okay, all right, interesting.
So yes, we move something from the audit side next. So far we've looked at from the audit side, we had what was it, Jan? The work plan by the IASB and what to expect.
Fraud, our videos. I will be talking now about a guide that the IFAC issued on what to expect in terms of sustainability assurance. So basically here it is a document outlining what we expect to be seeing, okay, in terms of this kind of assurance. So this document does say what stakeholders are going to see, okay, in the future. It is a phased approach on both reporting and assurance requirements, and basically the plan is for limited assurance to be provided on engagements and not reasonable assurance. The point of having limited assurance first is also because there is less work in a limited assurance engagement. So both from the auditor side and from the client side, we sort of go into this slowly, both in terms of costs, because naturally something that takes the auditor more time is going to add costs for the client. And in terms of the learning curve, as you know, the sustainability assurance side of things, sustainability in general is a fairly new
Indeed.
concept here. So it is a learning curve. It's going to be a big learning curve for a lot of us. So we do need to phase into this slowly to make sure we get it right.
And Jan, perhaps we can briefly describe the differences between limited and reasonable assurance.
Yes, I did mention that. Good question, Neville. With reasonable assurance, we're looking at a high level of assurance, but not an absolute level of assurance. When we say absolute, we're saying 100%. It means we've tested everything. So with reasonable assurance, we have gotten a very high level of assurance. So we have tested a good number of things, but we have not tested everything. As you know, we test on a sample basis, and we do test depending on where there is risk. And reasonable assurance is usually the kind of assurance we see in an audit of financial statements. In a reasonable assurance engagement, we gather sufficient and appropriate audit evidence. And our procedures are designed to obtain this reasonable assurance that the sustainability information we are auditing is free from material misstatement. Remember that the users of the financial statements are making decisions based on that information, and we want to make sure that it is free from any errors or any fraud, possibly any misstatement that could affect the decisions that users are going to be making based on that information. Alternatively, when we talk about limited assurance, we are gathering sufficient and appropriate audit evidence based on procedures that are more limited compared to reasonable assurance. And here, the conclusion is not that the information is free from material misstatement, but we are concluding that nothing has come to our attention to cause us to believe that the sustainability information may be materially misstated.
And that's reflected in the final audit report that we issue.
Exactly, and that would be given. Another thing worth noting, Neville, that was included in this what to expect document is the different types of modified assurance conclusions that we could give. Similar to the FS ones, okay, we're looking at a qualified opinion. You could have a disclaimer of opinion, or you could have an adverse opinion.
And so these are the usual.
Yes, that's it. The usual ones that you see in an FS audit. We do expect to see more modified opinions during the initial years of the reporting and assurance requirements, given that the whole concept as such is fairly new for the clients as well. So yes, we do expect there to be some errors, some mistakes, some misstatements along the way, which may cause us to have to modify our opinions. On the same topic, Neville, as well, the CEAOB, who is the Committee of European Auditing Oversight Bodies, did issue a public consultation document covering limited assurance on sustainability reporting. And what this document does is it basically includes some draft guidelines related to limited assurance engagement on sustainability reporting. It is a fairly broad document in the sense when you read it, it could include more. Maybe it could be a bit clearer, but however, it does definitely give us a base on what we want to be doing. So it would cover areas such as ethics, engagement acceptance, quality control, the objectives. It tells us for the objectives of a limited assurance engagement. It goes into fraud, material misstatements, risk assessment and identification. So quite a bit of detail there. definitely worth reading.
Obviously, target towards sustainability reporting.
Yes,
saying.
that's it. So again, the more guidelines we have here, the more hopefully we can more things to refer to, and hopefully it will ease our work if we have that reference.
Especially being a new thing for all of us.
That's it. It is going to be a learning curve, and I think over time it will hopefully just get easier. So that is the hope.
So, Jan, quite a bit of initiatives from the sustainability side of things, and from sustainability assurance, and also something related to sustainability reporting. In fact, we have something new this time from the ISB's end. So yes, climate change is a thing, and global warming is definitely with us.
Definitely, and unfortunately.
Unfortunately, we'll not be speaking about polar bears or what fuel you should be using, but we'll be focusing on power purchase agreements.
Our PPAs.
Our PPAs. In May, the ISB published an exposure draft proposing the amendments to IFRS 9 and IFRS 7, which try to simplify the impact or improve the way financial statements are reporting the impact of renewable energy contracts. So, what are these, and what is their aim, and why are companies using them? So yes, companies are trying to reduce their impact on climate change, and this is part of their strategy in order to ensure long-term access to renewable electricity. So be engaged in these contracts for renewable electricity, these PPAs, in order to ensure that they have a constant or hopefully a reliable supply of renewable electricity. Obviously, being dependent on natural sources, there's a limit to how reliable this source can be. But that's not the point. The point is that such companies have been facing some accounting challenges in the accounting for these contracts, be it with the application of the own use requirement exemption with an IFRS 9, but as well as hedge accounting. Recognizing the urgency, the ASB published an exposure draft related to the subject, and set a 90-day comment period on it, which is shorter than the usual 120 days because we are expecting an increase in the use of these PPAs. The proposals mainly seek clarifications with this own use exemption and with the application of hedge accounting requirements on these contracts, as well as improve disclosure requirements in order to clarify the company's stand and the future cash flows that are expected to take place due to these contracts. So the main aim is to try and simplify accounting for these companies which are using these contracts for operational purposes rather than for future trading purposes and for fair value gains out of them.
Okay. So quite a bit on that.
It's something that we're not usually used to, perhaps,
Yes.
especially in the local industry, but we should be seeing more of them, and the ISB is doing their best to keep up with the times and to ensure that the accounting standards are there to guide us with the application towards such contracts.
Okay.
Something similar in terms of intent is keeping up with the development of intangibles, with the development of intangible assets.
This was in discussion for quite a number of years, I believe.
It has. IS 38 has been drafted quite a good number of years back, I believe in 2000, where, the nature of intangible assets was not what we have today. So, yes, this one has been coming for quite a while, Jan. And in fact, I wrote about it in the past, in fact, within a short article that we published with the MIA back in February 23. Where back then, a younger, fuller-haired Neville wrote that in order to keep up with the current knowledge-based economy, it is important that accountants get their accounting for intangible assets right.
That's it.
Well, they are actually increasing their relevance, yes. But the current standard might fail to capture the true nature, the true value of these intangible assets. Say, for example, with respect to internally generated brands. You have a situation where if a company internally generates its brand, therefore the brand grew over a number of years, it is not possible for that company to recognize that brand on its balance sheet. If you have a similar company which acquired this brand, in that case it is possible for that brand to be recognized and to establish a value to that brand and see it on that company's balance sheet. So, and not a good step to what we might favor in terms of comparability, yet we hope that this will be fixed through such a comprehensive review.
Yes.
Obviously, we don't have an indication whether this will
In
be
terms
within
of
the scope of,
timeline, yeah.
of the review, but starting it is definitely a step into the right direction,
Yes.
at least from our end.
Thanks for that, Neville.
Uh,
There's also IAS 37.
Yes, there is
some-
also some movement with respect to IAS
Yeah.
37. In fact, we should expect an exposure draft to be published in the fourth quarter of 2024. And, well, we don't
We're talking
have
about
much.
provisions, contingent liabilities,
We're
and
talking
contingent
about-
assets in that case.
Indeed, and, well, no huge issues here, but, well, the standard as is working as it is intended to. But stakeholders have pointed out that, well, there is a bit of an inconsistency between what we have within the conceptual framework, which was published in 2018, and what we have in IAS 37. Due to the fact that IAS 37 might sometimes require the recognition of a provision of a liability, while it is possible that that liability would be contingent on an entity's future actions, which is not directly in line with the conceptual framework. Okay, Jan, so another update from the ESG side of things, we have the Corporate Sustainability Due Diligence Directive, where following a lengthy legislative process, the EU member states will have 2 years to implement this directive following formal adoption of this directive by the Council in May 2024. And we look forward to the adoption and the results of that directive.
Okay, more detail in the newsletter. We need to look at this.
Indeed.
I will just be ending this podcast, Neville, with something that came out recently, but that was not reported in our newsletter due to the fact that it had already been published by then. And this basically relates to guidance on auditor reporting with respect to less complex entities. So for those of you who might not know, the ISA for LCEs is a standalone standard. When we talk about LCEs, we're talking about less complex entities. And this standalone standard addresses the audit of less complex entities. So the guidance here is providing assistance for auditors with respect to any modifications to the auditor's report when using the standard. And it also includes information on any emphasis of matter or other matter paragraphs when you're reporting on other information, and also when reporting on any material uncertainties related to going concern, for example. You will also find in the guidance 8 illustrative auditor reports, which includes several different examples, 2 of which, for example, are an adverse opinion and disclaimer of opinion. So definitely a helpful guide to refer to those when required. Again, this is not included in our newsletter. However, should you require any further information on that,
Indeed.
please feel free to get in touch with us.
I believe we can wrap this one up here.
I think for those who have made it this far into our podcast, Neville, we hope you found it interesting and insightful.
Other than that, we thank all those who support us in the making of this podcast, and to all those who contribute to the newsletter and to this podcast itself.
Wishing you all a great summer, and thank you for listening.
We look forward to the next one. Goodbye.
Bye.